Welcome to the deep dive. We know you want to get up to speed quickly on important topics, and that's what we do here together.
That's right.
Today, we're digging into the U.S. economy. There are quite a few signals flashing, maybe suggesting some, well, turbulence ahead.
Definitely seeing some chatter about that.
And we're also going to look closely at gold. You know, it's getting a lot of attention, not just as that typical safe place to park money, but maybe as a bigger economic signpost.
Exactly. And we've got a good range of sources to help us unpack it all. We're looking at World Gold Council analysis on central banks, a Newsweek piece on recession flags,
Okay.
some history from Bullion Buy Post on gold and past recessions. LSEG has insights on gold's role, a Ronum on price history.
Lots of angles.
Yeah, and expert views from Forbes, Treasury spread data, gold futures perspectives, and reports from Discovery Alert and CBS News on why central banks are buying and what gold means for portfolios.
Okay, so our mission today, let's call it that, is pretty clear. We want to really get the key economic signals causing concern right now, and then explore gold's role in all this. It seems multifaceted. We'll definitely focus on what central banks are doing and, you know, what this might mean for you, the listener.
Sounds like a plan.
All right, let's dive in. Those economic indicators first, what's making people nervous?
Okay, so Newsweek, looking at what economists are saying, points to 5 main things. First up, consumer confidence. It's taken a hit.
How so?
Well, the Conference Board's index, it's the lowest since January 2021. And their expectations index, that's a key one. It's actually slipped below what they usually see before a recession.
Oh, okay. That sounds significant.
It is. And the University of Michigan survey shows something similar, sentiment weakening across the board, really.
And it's happening alongside other things.
Yeah, that's what Diane Swank at KPMG highlights. This drop in confidence is happening just as the job market seems to be softening a bit, and people are getting more worried about inflation again.
So kind of a double whammy for confidence.
Pretty much.
Uh-huh.
Now, Mark Zandi over at Moody's, he says it's not, quote, screaming recession yet. But he does admit the trend isn't going in the right direction. It's definitely something to watch.
Absolutely. And it goes beyond just feelings, right? People's actual finances seem stressed too.
That's the second indicator. Credit card debt, it hit a record $1.2 trillion late last year.
Wow, 1.2 trillion.
Yeah, and serious delinquencies, people really behind on payments, have more than doubled since early 2022.
That's a steep rise.
It is. And you've also got things like those buy now, pay later services. George Kamel points out they might be adding to the debt load for some people too. It paints a picture of growing pressure on households.
Okay, so consumers are feeling less confident and are more indebted. How does that connect to businesses?
Well, it leads to the third point.
Yeah.
Business uncertainty. The NFIB, that's the National Federation of Independent Business, their uncertainty index is hovering near its highest level ever recorded, basically since '73.
Near record high uncertainty.
Right. And fewer business owners think it's a good time to expand. That saw its steepest monthly drop since April 2020, right when the pandemic hit hard.
Not a good sign for growth.
No. And expectations for the economy improving are down too. Bill Dunkelberg at NFIB says rising labor costs are a top headache for them.
Understandable.
And the Atlanta Fed also reported businesses are just generally more uncertain about their future sales compared to before the pandemic. This kind of hesitation, it can definitely slow things down economy-wide.
And it seems like it's not just domestic worries for businesses, right? Trade policy keeps coming up.
That's indicator number 4, the Trade Policy Uncertainty Index. The St. Louis Fed tracks this, and it has just soared, record highs.
Higher than during the China trade war or the pandemic.
Even higher, yeah. The report mentions the sort of stop-start way tariffs are being implemented is really fueling the volatility.
So it's unpredictable.
Very. And Diane Swank again warns that these newer tariffs, they're often broader and stacked on top of existing ones.
Stacked. What does that mean?
Like you might have tariffs on Chinese goods, and then maybe also tariffs on, say, Venezuelan oil. The combined impact could push overall tariff levels higher than we've seen since, well, maybe the early 20th century.
That's a huge potential impact. Creates a lot of uncertainty for supply chains and
Exactly. Disruptions, caution, it all feeds back into that business uncertainty we just talked about.
Okay, and the fifth indicator.
Inflation expectations. Even though inflation itself might have cooled slightly from its peak, what people expect to happen is still elevated.
Right. Expectations matter.
They do. The University of Michigan survey shows people expect higher inflation in the year ahead, highest expectation level since November 2022. The Conference Board sees the same thing, increased 12-month expectations.
And what's driving that concern?
Stephanie Guichard suggests it's worries about prices for staples, essentials,
Yeah.
and also those tariffs again. They feed into inflation fears. There was even an Allianz Life survey where 71% of Americans expect inflation to actually get worse.
Wow. So the feeling is that inflation isn't really beaten yet.
That seems to be the prevailing sentiment, yes.
Yeah.
And that expectation itself can become a bit self-fulfilling sometimes.
So putting these 5 things together, confidence down, debt up, business uncertainty, trade worries, inflation fears, how close does that put us to an actual recession? What even is the definition economists use?
Good question. Diane Swank defines it generally as 2 straight quarters where GDP contracts, so the economy shrinks.
Okay.
And you also see a drop in employment. Now, the U.S. actually had GDP growth in Q4 2024, but unemployment did tick up just slightly in February, so it's mixed.
And the big banks and economists, are they all agreeing on a recession coming?
Not at all. It's really all over the map. Forbes highlighted this. You've got Goldman Sachs putting the probability at maybe 45%. UBS Wealth Management thinks we might dodge it. Bank of America doesn't have it in their main forecast.
Okay.
But then Morgan Stanley's around 40%.
Yeah.
JP Morgan Chase is higher at 60%. And Lauren Summers thinks the odds are, 6 and 10 or maybe better.
So considerable disagreement. It underscores the uncertainty.
Absolutely. And people are also watching things like the SAM rule. That's a specific labor market indicator looking for a certain rise in unemployment. It's getting attention right now as another potential signal.
Okay, so with all this uncertainty, this economic ambiguity swirling around, let's pivot to gold. It always seems to come up in these conversations as a safe haven.
That's precisely its historical reputation, yes. Gold has long been seen as that go-to asset when things feel unstable economically.
Why is that?
Sources like Bullion Buy Post and LSEG really emphasize its lack of strong correlation with other investments, like stocks or bonds.
Meaning it doesn't just move up and down with the stock market.
Generally, no, or at least not always in the same direction or magnitude. So when your stocks might be falling, gold could hold its value or potentially even rise. It's about diversification, spreading your risk.
So investors turn to it when they're worried? Does that mean gold prices automatically go up in a recession?
Well, automatically is a strong word, but historically, the trend is definitely there. Demand for gold tends to increase during recessions, which pushes prices up.
Got examples.
Sure. Bullion Buy Post, Aronum, CBS News, they all point to past recessions.
Yeah.
Think 1973-75, the early 80s recession, the dot-com bust aftermath around 2002, the 2008-09 financial crisis, even the short 2020 downturn. Gold generally performed well in those periods.
Generally. Any exceptions?
Yeah, Aronum notes some nuances. Like during the early dot-com bubble itself, gold didn't immediately take off. But overall, the pattern of gold being valuable during contractions holds up pretty well. And RJO Futures adds an interesting point. The really painful recessions often see gold outperform the most, like 1980, 82, or 2002.
Okay, so it's a recession hedge, but it's also seen as protection against other things too, right? Like inflation.
Exactly. That's another key role. It's widely viewed as a hedge against inflation and also currency devaluation.
How does the inflation part work?
Bullion Buy Post explains it well. When real interest rates go negative, meaning inflation is higher than the interest rate you'd get on, say, a savings account or a bond holding cash or bonds, actually loses you purchasing power.
Right.
Gold doesn't pay interest, but in that environment, it becomes relatively more attractive because it's expected to hold its value better against rising prices.
And LSEG has data on this.
They do. Their Exhibit 2 shows gold's price stats during past crisis periods like the 70s, early 80s, the GFC period, and more recently. It shows pretty solid returns historically during those times. And their Exhibit 3 connects gold prices to economic policy uncertainty, that index we mentioned earlier. When uncertainty goes up, gold prices tend to follow.
That makes intuitive sense. LSEG also mentioned something about seasonality. That seems unusual for gold.
Yeah, it's interesting. Exhibit 5 points out cultural factors. Big festivals like Diwali in India or the Lunar New Year in China and other East Asian markets, they drive significant demand for gold jewelry.
So cultural buying plays a role.
It's a big role. India and China are huge markets for gold consumption. Though LSEG does note Chinese retail demand softened just a little bit recently.
Okay, so individual investors often flock to gold when times are tough. But what about the biggest players?
Sure.
Central banks. Why do they hold gold?
Central banks. That's a huge part of the story right now. The World Gold Council says they hold gold for, well, safety, liquidity, and potential returns. Basically the same reasons anyone might hold it, but on a massive scale.
How much do they hold?
Collectively, about a fifth of all the gold ever mined. It's a substantial amount.
And are they buying more recently?
Dramatically more. LSEG's data, particularly Exhibit 6, shows a huge jump in net buying by central banks since late 2021. We're talking a 132% increase between 2021 and 2024 based on their analysis.
132%. Wow. Who's doing the buying?
Emerging market central banks have been especially active. LSEG and Discovery Alert suggest a couple of key drivers here.
Like what?
One is the geopolitical situation, particularly post-Ukraine invasion. Concerns about assets potentially being frozen or seized, geopolitical risk.
Right, diversifying away from assets that could be sanctioned?
Exactly. The other driver is inflation concerns, partly linked to things like the big expansion of the U.S. money supply, M2, during the pandemic. Central banks are looking for assets that hold value.
Is this buying happening everywhere or just in certain regions?
It seems pretty widespread. LSEG's Exhibit 7 shows physical gold reserves growing across Asia, Europe, Africa, South America between 2020 and 2024.
But not everywhere.
North America and Oceania stayed relatively flat, according to that data. But the overall trend is clearly towards more gold holding globally. And obviously, with prices also rising, the value of their gold holdings has jumped significantly up 51%, LSEG calculated.
So what's the core strategy behind this? Why gold specifically?
It boils down to diversification and resilience. LSEG and Discovery Alert frame it as central banks wanting to diversify their reserves away from maybe too much reliance on certain currencies or bonds.
Making their balance sheet stronger.
Yes, strengthening balance sheet resilience and preparing for potentially a more fragmented world order, both geopolitically and maybe even monetarily.
How does gold help with that?
Well, gold is seen as neutral. It's nobody's liability, as Byron King puts it in the Discovery Alert piece. It's not directly tied to any single country's political or economic decisions in the same way a treasury bond is.
And it can't be frozen remotely or sanctioned easily, especially if held physically.
Precisely. It's resistant to tariffs, acts as a hedge against outside shocks, and can support domestic monetary stability. LSEG's Exhibit 8 actually shows gold making up a larger percentage of central banks' total balance sheets, now rising from around 9% in late 2020 to about 13.5% more recently.
Are there specific countries leading this charge?
LSEG's Exhibit 9 points out some big movers between 2020 and 2024. China increased its official reserves by 17%. India even more, up 38%.
Wow. What about Europe or the UK?
The ECB and the UK have been pretty flat during that same period, according to the data.
So this buying, particularly from emerging markets in countries like China and India, Discovery Alert sees this as more than just tactical buying.
Yes. They frame it as a long-term strategic repositioning of national reserves, not just reacting to short-term news, but fundamentally shifting their asset mix.
What's the implication of that?
Well, it could create a more sustainable, higher floor for gold prices. And potentially, it could pave the way for gold to play a bigger role in international settlements, maybe as part of a basket of assets, as some countries look to reduce dependence on the U.S. dollar.
That's a pretty profound potential shift. Okay, so central banks are strategically buying. Individual investors see it as a safe haven. What about just including gold in a regular investment portfolio for diversification?
That's another key aspect. LSEG's Exhibit 10 is quite telling here. It shows gold's low correlation with other major asset classes, stocks, bonds, infrastructure, even crude oil.
We touched on that low correlation earlier. Why is it so important for a portfolio?
Because it means gold can potentially zig when other assets zag. Especially useful in times when stocks and bonds might be moving together, which sometimes happens. Gold can act as a stabilizer.
So it can potentially reduce overall portfolio risk.
And improve risk-adjusted returns, exactly. CBS News mentions this too, gold acting as a portfolio stabilizer when markets get choppy.
Do experts recommend a specific amount?
There's no single magic number, but CBS News cites ranges often suggested by financial pros, maybe somewhere between 5% and 20% of a portfolio, depending on individual circumstances and risk tolerance, of course.
And if someone decides they do want to add gold, how can they actually invest in it?
Several ways. There are gold ETFs, exchange-traded funds, that are easy to buy and sell like stocks.
Okay.
Mutual funds that focus on gold or mining companies. You can buy physical gold bars, coins. There are special gold IRAs. You can trade gold futures contracts.
Futures sound risky, though.
They definitely involve substantial risk, as RJO Futures points out. Futures are more for sophisticated traders usually. And then there are shares in gold mining companies.
What's the thinking behind buying mining stocks instead of gold itself?
Discovery Alert mentions that mining stocks can offer leveraged exposure, meaning if the gold price goes up, mining company profits and potentially their stock prices could go up even more.
Because their mining costs are relatively fixed.
Right. So higher gold prices can dramatically increase their profit margins. Discovery Alert suggests some miners might actually be undervalued right now, given current gold prices. But again, stocks have their own risks separate from the gold price.
So pros and cons to each method. Liquidity with ETFs, maybe, versus no counterparty risk with physical gold you hold yourself.
Exactly. It depends on your goals and comfort level.
Okay, one last connection. We talked about tariffs earlier as an economic indicator. How do tariffs specifically potentially impact gold?
Yeah, it loops back. That rising trade policy uncertainty and the actual tariffs being put in place, Discovery Alert suggests this can be supportive for gold. Well, tariffs can mess with supply chains. That increases economic uncertainty. They can also add to inflation pressures. And as we've discussed, uncertainty and inflation fears are two key things that often drive investors towards gold.
Right, it reinforces gold's appeal as that safe haven and inflation hedge.
Precisely.
Okay, this has been a really thorough deep dive. As we wrap up, what are the main things you think we should really take away?
I think there are three main threads. First, there's this undeniable confluence of concerning economic signals in the U.S., confidence, debt, business caution, trade friction, inflation worries that are all flashing yellow, maybe even red for some.
Okay, the warning signs.
Second, gold's enduring role. Historically, and right now, it's acting as that crucial safe haven asset during turmoil, offering diversification, hedging against inflation, currency worries.
Its traditional roles are still relevant.
Very much so. And third, the really significant strategic buying of gold by central banks globally. This isn't just noise. It seems like a deliberate long-term shift driven by geopolitics, inflation fears, and a desire for balance sheet resilience in a changing world.
And for individuals listening, it seems gold clearly has potential as a diversifier in a portfolio, especially when things feel uncertain like they do now.
Absolutely. Which leads to maybe a final thought for you, the listener, to ponder.
The one?
Given everything we're seeing, the economic climate, the moves by central banks, what role will gold play in the global financial system going forward? Could it become more central? And maybe more personally, how do you navigate these potential shifts? How do you position your own strategies?
Definitely food for thought. It encourages looking beyond the headlines and really thinking about the underlying dynamics of global finance and personal finance, too.
Exactly. Lots to consider.